There's a lot of ways to look at stocks when you're thinking about investing. Whether you're a new investor or you've been at this for a long time, it's important to understand the terms and terminology that help you understand and value the companies you're interested in investing in. So today we're going to do a quick video on price to earnings ratios, also known as PE ratios. These are really important for understanding and looking at the value of a stock, whether it's overpriced, underpriced, what kind of potential there is, but also how we want to look at these through a lens of fair valuation to its peers. So let me start by saying this. The most basic way of understanding this, and it's really quite simple, is a PE ratio is taking the company's current share price and dividing it by its earnings per share. And there you go. There's your PE ratio. Now, one caveat here is as we think about PE ratios and we want to understand where that valuation sits, you want to always be comparing peer-to-peer companies here. So look within the same sector, within the same industry, potentially going after the same types of clients. I'll give you an example. If you want to look at restaurants, let's make sure we're comparing two quick serve restaurants to each other as opposed to, a quick serve restaurant and a chemical manufacturer or potentially a high growth stock. High tech companies have a very different way of being understood than a company that's been around for 50 years with a stable user base. But let's just jump right into it for a second. There's really going to be two types of PE ratios we want to understand, and then this will help us look at the valuation of those stocks. There's a trailing price to earnings, and there's a forward price to earnings. A trailing price to earnings is looking at the previous 12 months earnings and using that as our guidance to potentially predict what we think is going to happen in the future. So it's very good to compare that when you're doing it for one company the same way for another. Now, conversely, a lot of companies come out with what they believe is their EPS guidance. This is sort of that forward-looking EPS, where we have to understand if we think what they're saying makes sense based on the research that they push out to the markets. Typically during quarterly and yearly releases, they'll give guidance on this. Now, not all companies do provide guidance, but many do. So let's think about it like this. When we figure out this PE ratio and we see that it has a high PE ratio, what does that mean? Well, it either means two things. The company has a huge amount of room for growth and they're going to be on a very aggressive growth plan, and we believe it based on what we've read from the research. Or a really high PE could mean that the stock is currently overpriced and something we should avoid. So one thing to think about here would be the company's gone through a huge period of growth, and that's led to this high PE ratio, but we don't really think they can continue this growth. So that's something you should think about before you invest in the stock, again, compared to other peers in the same sector. Now, a low PE ratio, conversely, could mean that the price is greatly undervalued if we see a lot of growth, both in the sector, but in particularly in the company. Or it could be a low PE ratio because there just is no more growth to be had here. So that's really going to set the baseline here. We want to understand, are we looking historically or are we looking forward with guided EPS? Do we think that they're undervalued or overvalued, and how we compare that to the research or the guidance given by the company? And again, this is really just a basic way of understanding how to look at something quickly, get a feel for it before we kick off our own research and decide if it's a good investment or not. I want to give a quick example of when EPS is going to be a problem in regards to price to earnings. So more than ever nowadays, we're seeing IPOs of companies that are wildly successful from a growth perspective. However, a lot of them, especially in the tech space, don't have current earnings. They're not profitable. There's no real true view of when they'll be profitable, or it could be several years in the future. PE ratios are not going to help you much here. You have to find a different way to do those, and we'll cover that in another video. But the reality is we want to make sure that we're always comparing things on a like-to-like basis. So don't take that hot IPO and compare it to a company like an IBM or a J&J or Coca-Cola for that matter. Always make sure we're looking at peers. A perfect example would be Coke versus Pepsi, IBM versus Oracle, and you get the point. So that's it for today. I want to keep it really simple and give you something you can use as you're looking into investing and deciding where to put your money. If you think there's value in what we're doing here and you want to continue following us, please hit that subscribe button. And if you think the video was good, hit the like button and leave a comment below. So that's it for today. Make sure to keep using those technical indicators and take a look at PE ratio and see what you think today. Thanks.